When central banks anticipate an economic downturn, the first order of business is to cut interest rates to stimulate economic growth. Lower interest rates tend to lead to more lending and more spending, which normally leads to economic expansion, while higher interest rates tend to lead to limited lending and reduced spending, thus curbing growth and inflation. However, what happens when the interest rate is near zero and the economy is still showing sluggish growth and high unemployment? Central banks such as the Federal Reserve resort to what is known as quantitative easing, QE. What is quantitative easing? Quantitative easing is when central banks inject money into the economy through the purchase of large amounts of financial assets from banks and other financial institutions in the hope of keeping long-term interest rates low and to promote economic activity. The central bank buys financial assets, such as government bonds and mortgage-backed securities. This increases the demand for these assets and puts upward pressure on their prices. As asset prices rise, their yield decreases. Lower yields on government bonds, for example, tend to drive interest rates lower, including those for mortgages and corporate bonds. Relieved from these assets with the huge influx of cash from the central bank, banks and other financial institutions now have plenty of free cash to lend and invest. One of the major concerns with quantitative easing is the potential for creating excessive inflation. Injecting a large amount of money into the economy can lead to rising prices if the increase in demand outpaces the growth in supply. For investors, quantitative easing can be very misleading, as it can distort financial markets by artificially inflating the price of bonds and stocks. This can lead to misallocation of capital and create bubbles that may burst when the central bank eventually stops its quantitative easing program. For sophisticated investors, quantitative easing can also mean huge investment opportunities. One such opportunity is inflation hedging, as quantitative easing is often implemented to prevent deflation and promote inflation. Investors can use quantitative easing-related asset price increase as a hedge by holding assets that historically perform well during inflationary periods, such as commodities or bonds. Thanks for watching. Don't forget to subscribe, like, and click the notification bell so you'll be notified whenever new content is uploaded.